We're rolling. Welcome to the REI Rookies Podcast, the Real Estate Investing Rookies Podcast, episode number 60, where we invite you to follow us on our journey towards financial freedom using the power of real estate. I'm Josh Koth, and I'm flying solo this week, and I have a great interview with Ben Jagim, an insurance agent who introduced me to different life insurance vehicles that can be used as funding sources for real estate purchases or really any investment. So we kind of go through that concept and how to be your own bank. So let's get into that interview with Ben Jagim right now. All right, I'm sitting here with Ben Jagim, an agent for American National. Is that correct? Did I say it right?
Yep, American National.
There's so many American families, farmers, whatever. I can't keep them all straight, but American National is the name of the company. I know Ben from being an insurance agent here locally, and he's done some work with us in the past, and he's in some networking groups. So Ben, thanks for coming on the podcast today. And we actually connected in real estate terms because I sent you a podcast and it had something called the infinite banking concept, right? I know you said that's a trademark name, so we're not allowed to say infinite banking, but that was what the concept was called. And I forwarded you this podcast, and I didn't understand what was going on at all with the vehicles were being used, how the money was being moved around. But I knew there's something here. There's access to more, capital, or just a little bit more freedom with your own money and ways to position money that would be advantageous to me as a real estate investor. I knew there was a spark, a seed of something there. So I forwarded you the episode and I said, can I do this? Or do you have products that we can do this with? And you said, well, let me dig into it. And what were you thinking when I sent you that podcast episode about infinite banking?
I was thinking that the product I already set you up with already does that. And I already explained this to you about 6 months earlier, but I get that it didn't sink in and everything. It's a concept people aren't very familiar with. So when I first kind of pitched it to you and we talked about it and everything, like, you understood it in that moment, but then it wasn't until someone else came back and was talking about this in a different arena that it kind of triggered that memory and everything. So,
well, you know what it was? It was that, when I was talking to you, I was thinking insurance stuff. Yep. And then when I was hearing this podcast, that was a real estate investor. So that's kind of what made me finally bridge the gap and see, okay, wait a minute, that actually could do this. I mean, I was just thinking from when I was dealing with you, I was just thinking I need some more insurance products, wanting to up my life insurance, just have the proper coverage in place. And that was really my goal, setting something up with you. But then I realized, wait, this could maybe be used actually to benefit my investing. And that's when I said, can mine do this? And luckily it was a product that could. So maybe you can kind of give us the really dumbed down, because I still am not 100% sure what the product does. I know that I can utilize money that I put in to invest and have more freedom than a lot of other retirement in quotes type accounts. And what do you call those? Qualified or
qualified accounts? Yep.
Okay,
so your 401ks, your IRAs, and everything. Yeah.
Okay. So how does this differ? How is this advantageous to a real estate investor?
Well, when we go to our meetups every week, what's the problem that we always hear about?
Number one, people can't find deals, and number two, they're having trouble getting financing for those deals.
Financing, right?
Yep.
It's, people aren't able to, they don't save up the money and everything. Money is always a problem. Where can you find the money to do these deals, even if you find them?
Mm-hmm.
Now, for a lot of people, it's not even that they don't have money saved up somewhere. A lot of people have large amounts of money saved up in your qualified accounts, your IRAs and 401ks. Right. So then what's the problem though?
Well, either you're not old enough to pull the money out, or you can only put in so much a year. You're limited by those contribution limits as well, right? So you can't put large sums in at a time.
Correct. You can't, if you miss 1 year, it's not like that rolls over to the next year and you can contribute twice as much or anything like that. So it's not only contribution, but it's also access. You just have very limited access with these qualified accounts. So, when you were first starting, you had a qualified account and everything, hundreds of thousands, but you couldn't really use any of that. You had to cash it all out, pay all your penalties and everything like that.
Penalties and taxes, which hurt a lot. But I knew real estate investing was a great vehicle to overcome the deficits incurred by pulling that out. It was still worth it, but boy, that was definitely painful. It would have been nice to avoid.
Yeah. So instead of having to pull that money out, what if you were able to borrow against the value of that in order to purchase properties? What kind of power would that give you as an investor?
Yeah, that'd be huge.
How so? Tell us about that side of things. And
yeah, I mean, anytime you can use leverage and have access to larger sums without having to pay a bunch of penalties. And see, the problem is if you have, in my IRA or 401k, I can't use that money to go buy something to buy an income producing asset. So, you're just limited by what you can do. I mean, I think there is some ways you can do loans against those types of accounts, but it's very limited, and there's a very, a small amount at a time and all kinds of conditions and stuff. So it's something that I hadn't even explored, but I knew was going to be tough to do. So, maybe you can explain how, when you get into one of these accounts, what you're allowed to use the money for.
Okay. So when it comes to life insurance, most people think a death benefit, right? If you die, your family gets this benefit.
Yeah. In fact, when I had term insurance for most of my, 20s and 30s, it was just there in case I dropped dead, basically, or got hit by a truck. And I had no concept of the fact that it could benefit me while I'm actually alive.
Yep. So that's just a term. You think temporary, you're only going to have that. Then there's permanent life insurance. It has these cash value accounts. So as you're paying in your premiums, your contributions, most of that money is going into this cash value savings account. And that savings account can earn interest depending on which strategy you use. Some of them are set to maximize that cash value account. And as that grows, you just have a lot more access to it. So let's kind of say you've been paying into this for several years and everything, putting money in there, and now you got $150,000 sitting in your cash value account.
Yep, I like it.
Yep. And now say you have a deal where you need $100,000 of cash in order to close on it fast and everything. If you had that,
because as we know as real estate investors, the most attractive offers you can make are all cash, no contingency type offers. So having a large sum sitting there ready to pull the trigger on deals, that's key. So that's kind of what Ben's speaking about here. So let's say, you had 150 in there, you needed 100 to pull a trigger on a deal.
Yep. So with this, you could withdraw all your premiums that you paid into there and everything. All of it went in post-tax, so you can take it out all tax-free and everything. But that's just your contributions. The other advantage is you can actually borrow against that. So the insurance company will give you a loan based on using your cash value account as collateral. So they'll give you a $100,000 loan in order to purchase that property. But the nice thing about it is, you get to set the repayment terms on that. Okay. So say you go ahead and purchase that property, and then later on, if you're flipping it, you don't have to pay it back right away. You can take your time, take a year. But here's the big thing about this is what sets it apart is that as that 100,000 is out there, they're going to give you a nice interest rate at about 4%. So say I got the kind of the numbers right here. Say you took a year, that 100,000 is now at 104,000. Well, that whole 150 that you still have in your account continues to grow as if all the money is still there.
Even when you have it pulled out in a property.
See, because you didn't actually withdraw the money.
Just took a loan.
You got a loan from the company based off of that. So your 150,000 is still in there earning interest. So say it earns 6% interest that year, and grows by 6%. So now your 150 is sitting at 159. Even though your loan is at 104. So you're really going to be outpacing whatever loan you have out there.
And then, so then let's say you have the balance out, you have 100,000 out because you borrowed it to purchase a property. Now, when you set in the repayment terms to pay back that loan, how are those set? Like, is it just arbitrary? You pick a number out of thin air, or is there some guidelines that they require?
They don't require anything. You set you could take 2 years in order to actually pay it back or anything, but you want to treat yourself like a bank. You want to set, hey, I want to make sure I pay this back and everything. But thing is, as that interest is accruing and everything, you pay that interest back into your cash value account. So even though you're getting charged interest, you pay it back into your account and consult with an account on this. But that interest that you're being charged, if it's for the purchase of real estate, that can still be a tax deduction and everything because you're paying that interest. So you set those terms, you can pay it back when you want to and everything. But you're still earning on your money even as it's that loan is out there.
Now, see, here's where this is hugely beneficial, because one of the first stumbling blocks we ran across, when I withdraw my money from my IRA and cashed out, paid all the taxes and penalties, I started using the money to put down 20% down and pick up houses. But then that money eventually you run out because you're taking these chunks. But then we learned, we actually went and got a line of credit on a house we own free and clear so we can make cash offers and then do a cash out refi in the back end. And that's been a much better strategy. So this would allow you, this account that you're speaking about, the strategy would allow you to make those cash offers, no contingency. Use yourself as the bank. Yep. And then instead of having a line of credit or something on a different property, you're basically loaning it to yourself. So I mean, the amount of hoops that you have to jump through is, limited. It's a much easier process because it's you making the determination. And then you can use that to pick up property and then do what we do now, which is then do a cash out refi once you own the property free and clear.
There it is.
Pay back the account and then just do it all over again. And then it's just a matter of how quickly can you line them up.
Yep.
And then you're only limited by how many properties you can find at a discount to do this strategy with. Yeah, that's pretty awesome. So let me ask you this. Okay, so what kind of restrictions or what are you allowed to purchase with the money that you do make a loan to yourself from this account? What are you allowed to purchase, and is there restrictions? Can you buy anything?
Oh, you can buy anything. Yeah, this is not, it doesn't have to be used for real estate. You can do this for car. Like if you're wanting to buy a new car, you don't have the money saved up, instead of financing or anything like that, you can take a loan out against your policy and then pay yourself back. Like once again, you want to pay yourself back. You want to set that monthly premium, but this time you're not paying interest to a bank or anything like that just to own a car. You're paying it back into yourself. Right. And then your money still continues to grow as if it's all still there. Wow. So this is just a way just to finance your life in anything instead of, we pay so much money in interest, whether it's credit cards, car payments, housing, mortgage, everything. So this is just a way for you to cut out the banks from that process and reap in those benefits yourself.
Right. Make you get all the benefits that the bank would get, pay yourself that interest rather than a corporation. But as real estate investors, we know it's important to use capital to purchase income producing assets. So that's, to me, the peak of the mountain of using this strategy is to purchase income producing real estate with it, do a cash out refi, pay back the account, just do it over and over again. And then it's just a matter of how many can you do in a year, right? Yep. Build up your portfolio using this strategy alone. Because when we were saving up money to have to either buy with all cash or make down payments, it takes a long time to save up the 20, 30,000 to make this down payment. But if you have access to one line of capital, all you have to do is save that up one time, enough to make one purchase of all cash of one property. Then if you can repay that back, then it's just a question of how many can you find in a year, and it will increase your frequency tenfold. Yep. So if you have to save up and buy one every 5 years, you can buy 10 a year. Yep.
But kind of on top of that, though, is that you still have to save up the money first. Like, exactly. We're talking about having 150 grand in there. Well, you have to put up that money first and everything. And so this is for people that are maybe contributing to other accounts that, you can switch those payments or those contributions and put it into something where you can have access to that. Not only that, but you can put in a lot more than $5,500 a year. It's whatever your budget really allows for. You can put in $1,000 a month into this.
So let's say somebody did
your budget.
Let's say somebody's doing like 3 or 4 flips, and you take the profits from that, and you could just use that to fund this account. And then once you get up to the point where the balance is high enough where you can purchase one house at a time, then really you're good to go. Yep. So just kind of whatever market you're in, whatever the average discounted price of a property that you would pick up as an income producing asset, once you reach that limit in your account or the ability to borrow against that amount, then you're pretty much set.
Yep. Well, and the other thing is, as you keep growing this account and everything, so say you're putting in $1,000 a month into this, you could put in an additional 5-10 grand over that baseline kind of $1,000, and that accumulates every year. So maybe right away your budget doesn't allow for very much, so you're just putting in your basic premium and everything. But say 20 years down the road, you want to start cashing out some of these properties and everything, you can put that that overfund that you didn't take advantage of, that accumulates every year. So at the end of 20 years, you could have an extra 200,000 that you could cash out, pay your taxes on, and then put it into this account.
Yeah. How about,
And
let's
then
say we had a property we own free and clear, we wanted to
Yep.
sell. Could we just sell that and take the proceeds and just put it right in the account and fund it right up?
Yeah, that's why this is such a great product for people, is it allows you to overfund it and build up those contributions both right now and then allow for a lot greater later on.
Now let's talk about, okay, so that, I love this as an investment strategy. Now, is there also...
It's not an investment. Let's make sure that's clear. This is not an investment.
As a tool.
This is a tool.
Okay,
Yep.
as a tool. So as a real estate investor, I like this product as a strategy. So that's a great aspect of it. Now let's talk about the insurance aspect of it. I mean, it still is an insurance policy, right?
Yes,
So
yep.
what other added benefits that most people might not even think about,
So
because they're using it as a strategy, as a tool.
Yep. So let's just say, first off, you're putting $1,000 into, you're overfunding your 401k. Like,
Right.
if something happens to you, your family's only get whatever you put into it.
Mm-hmm.
If you put $1,000 into this right away, you're 35 years old. That's over $1 million worth of life insurance right there.
Okay.
So if something happens to you, that $1 million can go to pay off all those mortgages that you have off of there,
Mm-hmm.
take care of things, take care of your family, or at least they have the cash flow to afford the mortgages on there.
Right.
So they aren't going to be forced to rush that or anything like that. So it's going to be able to take care of your family while you're building up that cash account and everything.
Cool.
The other nice thing is, say later on, say you're making your millions and everything, like that's the goal, right? We're
That's
wealthy and everything. We got more cash than we know what to do with.
Mm-hmm.
What do you want to actually do with your wealth once you actually get to that point? What's your why in that?
Yeah, to set up my family, my kids, grandkids, and to hopefully change the financial trajectory of my heirs, right?
Yep.
Legacy.
But with all that, if all you have your money is properties and everything, yeah, that produces nice cash flow and everything.
Mm-hmm.
But wouldn't it be nice to have a tax-free cash that you can just distribute it evenly among your family when you actually pass away and leave
Right.
that kind of legacy?
Mm-hmm.
So that's a way that, long-term benefit of that as well.
Right.
Is this is just another way to leave behind wealth. And that's why the wealthy control most of the cash value life insurance out there.
Yeah, that's funny because it's something I had no idea about until I met you and until I listened to this other podcast where they were speaking about how to use this as a strategy. So when let's say people wanted to reach out to you and ask about this as a strategy, what product, what is the name of the actual product so they know what we're talking about?
Well, there's different permanent life insurance products depending on what benefits. So you got whole life is probably the one that most people are familiar with.
But which is the one we're talking about that can actually do the strategy?
The overfunding and everything. So
Yep.
that's called an index universal life policy.
Okay, so that's what, if they call you up and ask for that,
Yep.
that's the key word.
So
there.
if you're looking for the flexibility with these policies is really what I like about them, that you can reduce your premiums, you can contribute more if you want to. There's usually, the growth on it is usually performed a little bit better over time.
Mm-hmm.
So that's why I really like these products. So, but not every company has these. So if you're looking for that and you go to your friend or somebody that works for a different company that doesn't offer it, they probably aren't going to talk to you about it or know the benefits of it and everything. Yep. So, and then there's a lot of other information out there about the downsides of these policies. And you'll probably hear expenses a lot, that these things are expensive, but that's where I encourage you to really dig deep on these policies. Because when you
do an apples to apples comparison.
Yep. No, exactly. Because you look at what you're paying in your mutual funds and everything like that, you add up all those expenses and you compare it to how these are set up. Mm-hmm. When these are set up right, I would love to go into the expenses talk with you.
Right.
And just do a comparison on that, because I think you're going to find that it works out pretty nicely for you.
Yeah. Well, just the flexibility, and if it allows you to grow your real estate portfolio using the cash offer strategy,
yep.
I mean, that right there is a huge benefit and over, your traditional retirement accounts that you think of. Yeah. I mean, it's funny how few people know about this strategy at all. And even me as a allegedly intelligent person found it very confusing right out of the gate. So, I mean, I appreciate you coming in, taking the time and really I mean, you've explained this 6 or 7 times to me now. So if that's what it takes,
I mean, people had to explain real estate to you 6 or 7 times before you got it, probably even more than that, and you're still learning. So that's what this is. And I love sitting down and talking about these and how they compare and the benefits that they provide and how it works so well with real estate investing. I think these two products, different tools and everything work very well together, more so than your traditional retirement accounts and everything.
Yeah, because if you can use it to purchase income producing assets, I mean, that's just a great combo that just exponentially can multiply each other. So Ben, if people wanted to reach out and ask you about this strategy and possibly get in some of these products themselves, what's the best way to reach you? You have an email address? Or?
I do have an email address. So it's ben.jagim, that's Jagim, at American-national.com.
That was a mouthful.
Yeah, it was. So
we'll put the show notes and put the email address and maybe your phone number in the show notes too. So if people want to reach out, they can just hit you up directly. And hey, Ben, thanks for coming in today. This is awesome. I'm excited. We got my account's building up right now, so I can't wait to hit that threshold. And I really like the idea of overfunding too. So we may take some flip money and try to accelerate that.
Yep.
Because I'm excited to get this going. All right. Well, thanks for coming in, Ben.
Oh, thank you.
Great one.